Hi, everyone. I have with me today again David Rogovic, Vice President, Senior Analyst from Moody's, to talk about a report that they recently released that looks at how the tourism industry is being affected worldwide by the pandemic and the implications that that has for the countries within its ratings universe at Moody's. We have quite a few in the Caribbean, but also there are other countries all over the world, like the Maldives, for example, that are tourism dependent that are also rated by Moody's. But for today's talk, we're going to focus on the Caribbean countries rated by Moody's and how they will be affected by the pandemic. Now, the first thing, David, welcome. Thanks again. It's great to have you. And if you can just walk me through a summary of the main findings of your report, that would be good. And then we can get into a bit of a discussion.
Sure. Thanks for having me, Marla. So in the report, we really want to look at the impact of a decline in tourism earnings on sovereigns, specifically those sovereigns that are most reliant on tourism. So, because of the coronavirus pandemic, we know that tourism will be one of the hardest hit sectors, with the recovery lagging the recovery in the broader economy. And in the Caribbean in particular, there are sovereigns, island economies like Barbados, Bahamas, Jamaica, which are all going to see a slump in tourism this year, and a significant slump, at least compared to historical precedent. And this we felt through not just lower growth, but worsening fiscal and external balances, a rise in debt, and a decline in international reserves or liquidity. And so what we did was, in trying to assess how these sovereigns would be impacted, we wanted to look at different scenarios for tourism activity and use that as a proxy for what that would do to tourism earnings, the impact that would have on real GDP growth, on fiscal balances, and on the current account balance. And so we looked at it three different scenarios: a 25%, 50%, and 75% decline in tourism earnings for the full year, and as a way to kind of assess the credit implications. And the main outcome of this study, this report we did, and the implications are the shock to tourism. The credit implications depend on not just the severity of the shock that we expect this year, but also the starting point in terms of, uh, of credit metrics. So um, what this means is that for countries coming into the shock this year, into the crisis this year, with already high debt burdens, with large current account deficits, and with low levels of foreign exchange reserves, the credit implications would be more significant than for a sovereign that has a lower stock of reserve, a lower level of debt, a higher share of foreign exchange reserves, and a smaller current account coming into it. Within the within the Caribbean, we see sort of sovereigns at both ends of the spectrums, ones that are more vulnerable and ones that are less vulnerable within or among tourism-dependent economies. On the one hand, you have countries in the report that we identified as most vulnerable, so that'll be the Bahamas, Belize, and St. Vincent and the Grenadines. In each case, tourism accounts for over a third of total GDP, including the indirect effect, and over 50% of exports, even more in some cases. And they already have high debt burdens. They already have some pressures from large current account deficits. Um, on the other hand, you have countries that have high debt burdens like a Jamaica or Barbados, where we see them as slightly less vulnerable. And the reason being for those two cases is because of the large primary surpluses they have coming into the crisis, which gives them some room to absorb the shock, at least on a temporary basis. Also, the reforms that both countries have undergone, in Jamaica's case over two IMF programs, in Barbados' case more recently, it gives us a little bit more confidence that after the crisis has faded, after the immediate shock, that we'll be more confident that they could sort of return to the pre-crisis trend of sizable primary surpluses, which would put these high debt burdens on a downward trend. Uh, just one other example of a country that we identified here in the report as being less vulnerable, and I think it's a more obvious example, but Cayman Islands. I mean, given the low debt burden it has, given low borrowing costs, this is a shock that we see, at least for the Cayman Islands, where they can absorb it without seeing any negative credit implications. I guess just one last point here. We're talking about tourism shock and a temporary shock, right? And so this is a one-year shock and a sluggish recovery that takes several years to return to this pre-crisis trend, to return to 2019 levels of tourism activity. That's the sort of scenario where our baseline scenario. but in a more negative, more severe scenario where tourism faces a prolonged slump over a 5 or 10-year period, the implications may be slightly different. And
Yes. But thanks for highlighting that my favorite country won't have negative credit
Mhm.
implications because of this. No, you're right, the Cayman Islands. And I mean, I said this in a tourism report that I did a couple of months ago that if only every country had had
Mhm.
low debt and fiscal buffers and strong external balances the way Cayman does. And that's the thing, when you're over dependent on any one sector, your risk is higher, your volatility is higher, and therefore what you need to do is have more buffers. And unless you're diversified like Jamaica or Dominican Republic, which still have a relatively high dependence on tourism, as your report rightly highlights, you need to keep these fiscal balances in check. But anyway, um, I've grown tired of saying this over and over in this region. Um, I wanted to ask you, you talked about the fact that the countries with the widest current account deficits are the ones that are more vulnerable to this shock, this decline in tourism activity. Tell me, what are your thoughts on foreign exchange controls? Because we have foreign exchange controls in Bahamas and Barbados as it relates to this shock that we're experiencing right now. As you rightly said, and I agree completely, Bahamas is most vulnerable simply because of their extremely high dependence on the sector, on tourism, but also the extremely high dependence on the US, and then on top of that, extremely high dependence on cruise tourism.
Mhm.
So yes, I agree with you that they're very vulnerable, and we saw them quickly reverse and retighten, if you will, their FX controls. And I'm seeing that Barbados is not. I mean, they were on a path to relax some of these foreign exchange controls. Now, tell me your thoughts on how this has implications for credit ratings, especially in the context of this shock, but also when we talk about FX controls, the downside, because there's a downside to everything, is that there is less, I suppose, willingness or attractiveness for FDI,
Mhm.
because foreign direct investors are afraid that they pour all of this capital in, and then when they would like to take a dividend out or take their profits out, they have to ask for permission to get the FX to take it out. And foreign direct investment is very important for growth in this region. So you have the positive effect of the FX controls in that it safeguards your reserves, but then it has that negative effect. And in a COVID context, I would imagine it's exacerbated. So grateful to hear your thoughts on that.
Sure. I mean, what I would say about FX controls is that it's one tool in the policy toolkit, right? So
Mhm.
the credit implications are really derived from their effectiveness. Do they restore stability in external financing? Do they contain the decline in international reserves? And what are the costs? Like I said, there always going to be costs and benefits to any policy. In this case, what are the financial costs? What are the economic costs associated with this distortion that they bring to the market, right? If they're short-lived, then it's not really credit relevant. There's not much relevance there, right? If it's longer lasting, then that's where we think more about these negative implications. So again, it's just part of a policy toolkit. In the case of Bahamas, capital controls are sort of a key measure there to support reserve levels and maintain the peg. Although I think in recent years before COVID-19, we had seen some increased flexibility. Now, in coming into the shock this year, reserves were high. Part of it is because of the post-Dorian insurance payments. So they were, I think, about 2 billion, like 28 weeks of imports. But even with these capital controls, we're going to see a decline in reserves this year. I think the central scenario there is for reserves to decline by about a billion or down to 1 billion at year end. This is a central bank scenario. So in a case like this, where you're facing a significant shock, uh, without FX controls, you would see an even further drawdown on reserves. So if the policy priority is to maintain the peg, then the capital controls, could be would be considered effective or could be effective in this case. Again, assuming that this is a temporary shock and that that they're not going to have to be tightened further into the future to maintain reserves.
No, I agree. And yeah, everything has a trade-off, but I do see that this is serving them well right now. And then tell me what your thoughts are, I mean, on, as you mentioned, as we discussed, the foreign exchange controls being relatively effective for fixed exchange rates. But what about the flexible exchange rates? So you have Jamaica and the Dominican Republic, and we saw that the DR, their currency depreciated quite significantly for this year so far, year on year. What are your thoughts on that as a policy measure, and how, because it relieves some pressure on the level of reserves, its efficacy and support for the credit rating?
Yeah. I mean, so again, it's similar to what I said about FX controls. It's part of the policy toolkit, right? In the case of Jamaica or Dominican Republic, they have this option where they have a more flexible exchange rate, while sovereigns with the peg don't have it. In the case of Jamaica, the greater exchange rate flexibility also gives them a little bit more flexibility on the monetary policy side as well to support the economy. And we've seen that through lowering interest rates and through other measures providing liquidity to the banking sector. So I think it does give them more flexibility, but it has to be in the right context. I mean, for Jamaica, they've gone through a number of years of reforms, and the exchange market, the more flexible exchange market, has started to work and is starting to be developed. But there are still areas to be worked out, and it's still a work in progress, so to speak. So, but it's this more stable macroeconomic environment that was created by the structural reforms, more stable and low inflation that would allow flexible exchange rate to work in this environment, or to actually provide additional policy flexibility. If you don't have that starting condition, then the flexible exchange rate may help absorb a shock to some extent, but the offset would be costs elsewhere or challenges elsewhere in maintaining that the stable exchange rate after the initial shock. And I mean, even in the case of Jamaica, there are costs as well, right? I mean, we're projecting an increase in the debt burden this year, not just because of growth declining, real GDP growth being negative, nominal GDP growth being negative, smaller primary surplus, but also because of the exchange rate. And after the initial depreciation that we saw, there has been more stability now. Part of it, I think, is a reflection of the IMF money coming in and boosting reserves, but also I think a sense of there's a sense of policy credibility there that they wouldn't let the exchange rate weaken or get out of control to the downside, and so we've seen some stability more recently, but it seems to work well for the Jamaican authorities and in that context. But again, it's part of a toolkit that policymakers in each country have. FX pegs, flexible exchange rates, FX controls, more open capital accounts.
Yeah, I think it has served them well. And historically, is because they've been able to, I guess, maintain price competitiveness for their tourism product as well. Because if you look historically at how tourism arrivals have moved for Jamaica and DR, they've been steadily growing, on average higher than most countries with fixed exchange rates. So it has served them well in that regard as well. So with respect to that same point about record numbers of tourism arrivals, I mean 2019 was a record year for many countries in this region, and following the global financial crisis, for some countries it took years for them to get back to pre-crisis levels of tourism activity. And I saw in your report that you looked at a scenario where you're looking at the tourism being impacted for a period of time, and then there's some recovery in 2021. My own view is that it's going to take years for us to get back to 2019 levels. I mean, I think on average it might take us 5 years. And the reason I say that is because we have demand side effects, obviously, but we have supply side effects, which we well know, because the airline industry has taken a hit, the cruise industry has taken a hit. But not just that. If you think about the tourism inventory itself, the hotels and I mean, I think Airbnbs might be more stable, but the hotels that have to close down and may have to, some of them might have to go into foreclosure. I think that the industry itself is taking a leg down in that regard as well. And I'm wondering if certain countries are going to suffer or see like are going to see almost an irreparable decline in this sector because you might have foreclosures that take a long time to be resolved. Um, who's buying in this environment? Who's buying in the tourism sector in this environment? You might have a situation where people employed in this sector will find work in other sectors, and so the supply of labor, and, or people even willing to go back to work in that sector because they realize how vulnerable it is. I have a feeling that these kinds of shifts are going to take place in this sector. Tell me your thoughts on that.
Yeah, no, I mean, there's a number of good points there. I think, when I talked earlier about the sovereigns most and least vulnerable, again, it was in this baseline that there's a recovery and it's a gradual recovery beginning next year. We don't get to the 2019 level of tourists for several years, but um, this is a temporary shock, right? In this baseline scenario, I think there are clearly more risks to the downside in the tourism sector, and the multi-year slump is something different than one that we begin to see some signs of recovery next year or the year after that. And it's possible, like I said, for a number of reasons you mentioned, but changes in consumer behavior when it comes to travel. One thing that we discussed in the report is the importance of domestic tourism, and that we talk about tourism as one industry, but we think there'll be a recovery first in domestic tourism, then more in international tourism. For the Caribbean, they don't have as large of a domestic tourism market as you see in, say, Western Europe, right? Where even if international tourists aren't willing to come to some of these countries, there's a domestic market that you can get tourists to spend and stay in hotels and to keep these businesses afloat and keep activity, even if occupancy isn't at 100%, it's at something greater than zero, right? So that's one area where I think the Caribbean is a as a region for the most part doesn't have a domestic tourism market that's as vibrant as elsewhere. Another reason why we could see a long prolonged slump is you mentioned flight capacity, but if an airlines are facing financial difficulties, if you reduce the number of flights to a given country per week, that's going to have an impact on the number of tourists that could visit a country. Not to even mention just the impact of the crisis in the U.S. in terms of unemployment and lower income levels, and what that will do to demand for tourism products in different countries. We also touched upon the cruise ship industry in countries like the Bahamas or Jamaica, where maybe that part of the tourism product is slower to recover, and while they do spend less, it's still an important relative to stayovers. It's still an important source of FX earnings for these countries. But I mean, within the this sort of global picture, I think there are some bright spots. So I mean, you talk about the Caribbean, and some countries may not see recovery in tourism because of long flights, 3-4 hour flights from key source markets, but maybe the Bahamas, for instance, could have an advantage there being so close to the U.S. that maybe people are willing to go travel by sea or take a shorter flight. So there could be some differentiation there as well. But I think in general, it's easier to imagine with some of these more negative scenarios. If you think about the balance of risks being to the upside or downside, probably more to the downside that we see a more prolonged slump. And then in that case, I mean, even the sovereigns that we talk about as being slightly more resilient, they still rely on tourism heavily, and it's hard to diversify away when you have risks such as from natural disasters, from uh, having a challenging starting point in terms of a small manufacturing base. I mean, Dominican Republic are more diversified, but they still will have to rely on tourism to some extent, I think, over the longer term.
No, I agree. I think the only market in this region that has a thriving staycation element of its tourism market is Puerto Rico, and we don't
Mm.
always count them as part of the
Yeah.
Caribbean. Um, but I am seeing, regionally and here in Barbados as well, there's been a bit of a recognition of that um, possibility, and so staycation packages being advertise and so on. I mean, people are tired of being at home and working from home and not going anywhere and in the house with kids, and so it is a possibility. I think there's a good chance that's relatively small segment of the market can grow for the region. But you're right, it could never displace the tourists we get from outside. But it's still better than nothing. The final question I wanted to chat with you about, David, is we have many countries in this region that have debt levels that are already unsustainable, in the sense that they have primary fiscal deficits, so that they're already borrowing to service interest on their existing debt, or they're on this dark side of the debt sustainability curve, such that each additional dollar of debt is placing negative pressure on GDP. This is according to some research done by Kevin Greenidge and friends at the IMF. And I just from a policy perspective, I mean, this is an unprecedented shock we're dealing with in this region. And if I was a policymaker, I might think to myself, especially if I have the political capital to do so, if I'm not close to an election, I might think about having something like a preemptive debt restructure, so that I can consolidate my debt, borrow more, because I, of course, would need to borrow more at this time to support jobs, to support the private sector, to maintain stability in my economy, and social implications as well, for poverty, for healthcare, and all of these things that have come under strain. I don't see that necessarily being practical from a political standpoint. And it's not that I expect countries to do this, but I'm just thinking out loud, and I just want to know, what are your thoughts from a ratings agency perspective on countries sort of putting their hand up and volunteering for preemptive, orderly default / restructure, as opposed to what we've had in the past with Barbados, with Belize, and Jamaica, historically, where we've waited till we've hit rock bottom and we've depleted everything before we go to the IMF and say I have a balance of payments crisis. And I think that's what happened in Suriname already. And I think that that's what's going to happen in Trinidad. I mean, I would love to think that Trinidad and Tobago would be more proactive and preemptive should like right after the next election. But I have a feeling they're going to just run everything into the ground before they surrender. But what are your thoughts on that kind of a scenario of a sort of a preemptive debt restructure?
Yeah, I mean, I think what we've seen so far in the policy response from governments is, in terms of the fiscal policy response, we've seen sort of most governments letting automatic stabilizers work and saying, we'll see a temporary deviation, we'll see a temporary deterioration in our fiscal balance, either fiscal deficit or smaller surplus. And this is really to address the health crisis first and foremost, right? And in some cases, we've seen some economic stimulus measures being announced as well. But I mean, in the Caribbean, tourism-based economies, but I think even more globally, we've seen sort of preference to allow automatic stabilizers to work. We're not seeing governments rein in or cut capex to limit the deterioration in the fiscal balance, right? And so that means that debt levels will rise, and that creates larger gross financing needs for these governments. And we've seen the IMF and others in the international community, multilateral, providing a significant amount of liquidity to these governments to cover those financing needs, to boost or prop up reserves. And as long as the shock is temporary, and as long as you can return to the pre-crisis growth rates or pre-crisis sort of environment of fiscal dynamics of growth rates, current account balances, then I think we can see a rise in the debt burden that's temporary and kind of look through it from a ratings perspective. But and that's probably the case in a country like Jamaica, right, where we see this deterioration. We think it's going to be temporary, and they should return to what what we saw before the crisis, right? Maybe slightly higher growth rates at some point. But there are other cases. When we look in the Caribbean, you think about the countries in the rated universe there. And we have seen negative rating actions in the Bahamas, in Belize's case down to CAA1 with the negative outlook still. And just thinking about the other sovereigns we have in the space there, I mean, St. Vincent and the Grenadines we mentioned as being one of the most vulnerable, but there's not much debt to default on. So at a B3 rating level, it's still somewhat resilient. It's at the lower end of the spectrum, which I think already captures their vulnerability to a shock like this. And like I said, there's not much debt there to actually default on that would move the rating lower. Then you have a country like Barbados at CAA1, which is just exiting and restructuring and default, and that CAA1 rating captures that level there. And again, thinking about the countries at the lower end of the rating spectrum, the last one in the Caribbean is really Jamaica, which at B2, I think this shock is something that sort of maybe caps any upside for the time being. And if it's more prolonged over a 3, 4, 5 year period, then we could look at where the rating would go. But for now, at B2 stable, sort of more resilient at that rating level, given the improvements we've seen leading up to the crisis. So your question in terms of the Caribbean and these tourism-based economies, it's the country at the lower end of the rating level have either we've already taken action on them and moved the rating down in anticipation of some event, or in other cases we think there's a bit of resiliency because the rating is already at such a level that in fact captures all of these risks that you're talking about. These are risks, right? Or we don't see them as being something that is likely at the higher end of the rating spectrum. So when we talk about Bahamas, I mean the rating is lower, but not to the point where we're moving down to very low speculative grade ratings. So I think in the Caribbean we have the ratings sort of appropriately balanced to balance the risks of a longer term deterioration in credit metrics that could precipitate a default or restructuring in the future, and to capture sort of some of the inherent vulnerabilities that we think exist even before the crisis.
Yeah. I think you're right, and I feel like there is already some room in there in the where the ratings are, provided it doesn't go too much longer. And we already see, I mean, in your report, you do different scenarios of what the tourism hit would look like. In your worst case scenario, 75% fall off in tourism activity, basically. Um, I I think that now that we're seeing countries opening back up in very measured ways, it looks as though unless we get a massive second wave, it looks as though some of us are going to be open in August, but with certain testing and isolation protocols in place. So there is a chance that there's going to be some measure of activity in the second half, and for sure the fourth quarter of this year, again, barring a massive second or third wave, if you will. So I mean, I appreciate that the report that you've prepared, and that you went into such detail explaining the implications particularly for the Caribbean countries. It's a really fascinating analysis, and I thank you for that. I mean, it's a great piece of work.
Yeah. Thanks, Marla.
Any closing thoughts?
No, again, always happy to be here and really appreciate your views as well. Glad you found the report interesting.
Yeah, definitely. So we'll try our best to make sure that we continue to highlight all of the work that Moody's does on the region, because of course these are very, very difficult times, and information is scarce, and everybody wants to know what's going to happen next. So this was very helpful in terms of looking at the implications for the credit rating. So thank you very much for that. And we'll do this again soon. Thank you, David.